Recession, market crash, Sahm Rule, panic in the markets. So many things happened last week. There's a lot of things to discuss. This is going to be a good one. My name is Den Slim and welcome to another episode of Monday Market Outlook. Last week, three of the biggest economic indicators were released. Let's start with the unemployment data. While the US is struggling with a weak labor market, Philippine unemployment rate dips to an 18-year low. Unemployment rate was down 3.1% from last month's 4.1%, breaking a 4-month acceleration. More good news last week with second quarter GDP numbers also coming in at a surprise 6.3% above forecast. This was a marked improvement over the 5.8% last quarter, and this marks the third straight month of growth. But we also have to be careful of these numbers because first, base effect. Last Q2 2023, that was an extraordinarily down quarter, so we're comparing numbers from that. So naturally, the low base last year contributed to the strong number. Second, GDP growth mainly driven by government spending, a whopping 10.7%, and gross capital formation at 11.5%. Again, we see household spending stagnant at 4.6%. Can the government continue to push the economy up, right? Some say it's unlikely. I mean, look at previous numbers, right? The government hasn't really shown a propensity to spend too much. Plus, as the rainy season ramps up, some construction projects may be put on hold and we could see these numbers decline next quarter, right? But we'll see. Earlier last week, though, inflation numbers caused some alarm as the July read came in at 4.4%. Not only was it a big jump from the 3.7% reading last month, but it was also much higher than the 4% threshold for the BSP. And even on a month-on-month basis, right, the numbers didn't look too encouraging as the inflation numbers grew 0.6%. On a core basis, though, which excludes volatile components such as food and energy, the core inflation rate did go down to just 2.9%, which is encouraging, right? Again, food inflation taking up 6.4% and the energy component surging up 2.3% last July. So what do we have, right? So we have inflation is up, GDP numbers very strong, unemployment rate down. These factors contributing to the scenario that the BSP has less reason to cut rates this week on their August 15 monetary board, right? But let's look at some positives. Inflation rate may be up, but the biggest component, rice, has peaked and is projected to go down further, easing pressure on inflation numbers moving forward. Now, second, remember that the culprit for this month's inflation was the uptick in electricity prices. And this should be temporary because if you notice, right, Meralco sent out a text message about a delay because the ERC had some adjustments, etc. The recalculation and adjustments ordered by the ERC really was the cause of this temporary spike. And as you can see, the weaker part of the year in terms of electricity demand should also keep energy prices down moving forward. So overall, inflation forecast still puts us on track for a 3.5% rate by next year. I mean, it will have its ups and downs. And also, if you look at the August and September reads last year, we could have base effects improve the numbers for next month. Lastly, the peso has continued to be strong against the dollar despite the anticipated rate cuts for the BSP. A rate cut really not much at risk here if the BSP does cut rates this August. Now let's look at some earnings results so far. Overall, Philippine companies averaging 9.3, 9.6% year-on-year growth. Some declines may not even look that bad. SCC, despite the earnings decline, is largely anticipated. And if you look at the full year targets, they are actually way above their full year forecast. Looking at the current favorites, we have BPI, right? CNPF, we have Globe, we have Meralco, and even SMPH. You can see them all doing quite well, both on the technical and on their fundamentals. Let's look at the PSEI charts. The index back in the driver's seat with a 1.5% rally last Friday, ending right smack into the 6650 resistance zone, right? If we look at the 1 hour time frame here, we can see that the index was actually trending downwards, and last Friday's price action was actually a break of structure. So hopefully we can retest support here and bounce back and continue the rally into the rate announcement this Thursday. Going back to the dailies, we mentioned that a breach here could put us on track for 6,400, and this is exactly what happened. Instant rejection on that level, an overreaction here, and a great opportunity to buy the dip. Did you panic last week? And if you stayed calm, you could have bought into this rally. If not, then okay, it's okay. You will get your chance once the markets retrace back to 65.75. Now, looking at the weekly heat map, we can see Ayala stocks very strong this week. BPI pulled down by index rebalancing. So will you panic, or is this an opportunity to buy the dip, right? A lot of issues still reeling from the initial shock, especially conglomerates, URC, AEV, and JGS. Be careful entering into these stocks. Remember, they are on a downward trend. Any shocks into the system, these stocks will lag in terms of bouncing back compared to other stocks. Now, let's look at some stock highlights. Let's look at some REITs, guys. I've been harping about a REIT for a long time now. 33 is a great price to enter. 32, much better. Now, it's at 38.15. Buy the dip here at 36.50 if you want. Better if you can buy at 35.70. RCR, look at our buy zones here. Congratulations if you were able to enter here. Right now, the opportunity to buy is at around 5.50. C-REIT, also buy at support if you can. Now, as discussed last week, ASEN, there was an opportunity to buy after the breakout. ASEN, pulling back to our buy the dip zone. Were you able to buy, or did you panic? Congratulations if you were able to buy ASEN on the dip. We have a resistance here at 550. A breakout here could put us up to 586. Retrace back to 550 would be a good entry. Let's see if it consolidates or if it breaks out this week. Another stock with good reversal signals, Converge. Look at that rally. Don't worry about missing out on these levels. What's more important, you buy and sell higher. It doesn't have to be buy the lowest and sell high. Right, so an opportunity to enter Converge if it pulls back to 1090 or even 1050. Lastly, Monde. Is this the bottom for Monde? Now, Q2 net income down 20%. Does not look good, but is that priced in here? You have some revaluation of their guarantee assets for their meat alternative business. You have your gross profit margins lower due to Forex adjustments. And for some reason, right, they were not able to produce Skyflakes for 2 weeks. What's that, right? Microsoft CrowdStrike thing? I don't know. Again, is this the bottom for Monde? Look for a test of 984, retest of support 941, head and shoulders formation, or a double bottom. Wait for better signals before entering in. Be patient. Let's go to the S&P 500. It was a scary week for the US markets as the S&P 500 actually dropped 4% here before the day ended, putting the index back into the 5186 zone here. It briefly tapped into the 200-day EMA before it recovered back into this critical area. The rejection in the next days was a bit concerning, but the jobs numbers proving the doomsayers wrong as the S&P 500 bounced back strongly on Thursday, and on Friday the S&P 500 completed a major comeback, wiping out all of the losses last Monday. Now going to the weeklies, look at that rejection here, a very large hammer doji. Could this be a sign of a reversal, right? And if we look at the VIX, what happened to the VIX last week? It jumped to 66 before quickly moving back into the more calm 23 zones. Usually these types of quick turnarounds do signal a market bottom. So if we go back to the S&P 500, we could see a potential gap fill for the S&P 500 back into 5,400. This will be a key area. 2 resistance lines here. We could consolidate along this area, or let's see if the bears can manage to come in and take a cut from the markets. What exactly happened last week? What was this overreaction? The US economy got a shock as the news headlines were filled with news about the Sahm indicator being triggered. I'm sure you've read about the Sahm indicator somewhere because this happened a couple of Fridays ago. But I didn't realize this is going to be a big deal. What is the Sahm Rule? It basically is a recession indicator which signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage point. And this was triggered, 0.5%. This was triggered last Friday. And as you can see, the Sahm indicator has said to be very consistent. We see here the Sahm Rule being triggered, recession. Sahm Rule being triggered, recession. Sahm Rule triggered, recession. Sahm Rule triggered, recession. Much so that it is said to have a 100% accuracy in indicating a recession, which is, it's a head scratcher. The Sahm Rule has never been 100% accurate, guys, right? If you look at how the Sahm Rule has performed, it has had 2 misses. One in 1960 and one in 1974. See, right? Recession starts, the Sahm Rule triggers, right? Recession starts, the Sahm Rule is triggered. I mean, here, the Sahm Rule was already triggered, but it was 5 months before recession started. Here, recession already started and the Sahm Rule was not triggered until very late, 8 months after recession. So, even the creator of the Sahm Rule, Claudia Sahm, admits to this, right? We are not in a recession. We should not be in panic mode. And there are still key measures of the economy that still look pretty good. And it really goes to the #1 rule of analyzing the economy: don't count on the signal of a single metric, right? So, let's look at some metrics here. Let's go back to the recession indicators. Is GDP down? No, 2.8%. Inflation rate is down. Manufacturing numbers are down, okay. Unemployment rate numbers are up, okay. Recession. But this week, initial jobless claims came as a surprise, 233,000, which was well below the 250,000 expectations. Also, let's look at the housing market. Existing home sales down, new home sales down. But housing starts, very steady, right? Now, the difference between new home sales and housing starts is based on how many homes are actually bought, and housing starts measures how many houses home builders are starting to build. Now, what does this mean? What does this uptick mean? This means that the confidence level of home builders is going up. Why? Rate cuts. Rate cuts will make it more attractive to take out housing loans. And speaking of loans, how's the default rate? Loan default rates are actually on a decline, right? Now, see how the default rate went up before we entered into the 2020 recession and then before it spiked up. Right now, default rates are actually on a decline. Corporate earnings, does this look like an economy entering into a recession? 12% average, better than our local 9.3, 9.6%. We have 79% of the S&P 500 companies already reported earnings. Blue means they reported above expectations, within expectations, and black is below expectations. This is overwhelmingly blue, right? So guys, stick to the basics, look at the numbers, and remember, you will get contradictory statements if you read too much news, even from the same source. We are not here to ridicule any analyst, and of course, anybody is welcome to flip their statements or flip their views anytime. Now, what we're trying to say here is that nobody is going to look after your needs and your portfolio better than yourself, right? There are a million pieces of information on the internet, all vying for your attention, right? And most of them really not worth your time. What will help you filter them out is your own plan on dealing with these kinds of situations, right? Each company will have their own goals and reasons. And this is why you will get contradictory statements even on the same topic. Remember guys, they are called indicators for a reason because they are simply indicative and they are never definitive of anything happening. Again, basic rule of reading the economy, do not count on a single metric. I mean, you can't blame people because the next day, the Japanese market plunged 12% in its largest ever point fall, falling 4,451 points last Monday. Remember that the Bank of Japan has started a wave of monetary tightening that caused the yen to sharply appreciate against the dollar. The Bank of Japan raised interest rates to 0.25%. Compare that to the Philippines, 6.5. Compare that to the US, 5.5%. 0.25 is actually very small. But see how Japan has kept interest rates at zero and even negative starting in 2016. Japan has actually raised interest rates last year, 0.1%. And that was actually big news also about the carry trade. And this latest move, raising it to 0.25, started the biggest unwinding of the carry trade last week. What is the carry trade? You can probably find other resources on the internet that could explain this in further detail or that could explain this better. But let's quickly discuss this and connect this to what happened to the markets last week. At its most basic, and trust me, this is way more complicated than this, right? The carry trade simply means borrowing from a low interest rate currency, in this case the yen, 0% interest rate, and investing it in a high interest rate country like the US, 5.5%. Wow, look at that difference. You actually earn money from borrowed capital. You didn't shell out any money. You can do this every week, every month. Some even do this on a daily basis, just rotating funds, right? Let's see how profitable the carry trade has been. Imagine you took out a 115 million yen loan, which can buy you 1 million US dollars back in 2022. You would have earned that spike, this spike in interest rate difference. Remember, 0% interest rate. So any spike here means you earn all of that, right? 35,000 estimated in 2022, 40,000 2023. Interest rates were at 5.5%, 55,000 in 2024. Not only that, remember, you borrowed 150 million yen in 2022. You used to buy 1 million US dollars. And that 1 million US dollars, right? If you're going to pay back your 115 million Japanese yen now, that will only cost you 781,000. So you actually pocket the change plus all these interest payments. Now remember, before the crash, the yen was 156, right? So it was really just investors unwinding these positions. And here's another scenario. Some investors borrowed. Again, they bought US dollars. Where did they invest? They invested in the Mag 7 stocks or even the Magman stocks, right? These stocks are up 140%, even 168% at its peak, with the Magman stocks down hard in the last weeks. And the US dollar's significant weakness brought about by the rate hikes, it's just natural for the markets to take profits from those positions. Remember, you cannot unwind the biggest carry trade in the world without breaking a few heads. And this is exactly what happened last week. And to further complicate things, remember, 2 years, a lot of investors may have entered into leverage positions, right? Meaning, instead of investing 1 million worth of capital, right? Because you borrowed 1 million worth of US dollars, right? They entered into a contract for difference, or they leveraged their investments. So you can times 2 or times 5. So if you times 2 this, that's 2 million using only 1 million of your money. You bought here at 136, then suddenly this is a 32% loss. That 32% loss is 640,000. So your 1 million now is 360,000. So now you will get a call from your broker, and this is what is called a margin call. Because your fund is below 50% of this 1 million, they will automatically close the position. And remember, you borrowed 1 million, you now only have 360,000 as a collateral. So the Japanese bank will call you and tell you to add to your collateral to cover your loan, right? So again, this is just the carry trade unwinding. Are we in a recession? No. So this is just another day in the markets. Remember, guys, just to keep calm and carry on. Now, just like that, the chances of a 50 basis point rate cut this December has shifted to almost equal chances. Remember, last week, that was 74%. Now, it's 54%. If you look at the carry trade itself, the definition, 0.25, even if we go to 5%, the carry trade is still very much alive, right? So, what tends to happen? When the Fed cuts rates, let's look at some historical data. Generally, we do tend to get a slight pullback months leading into the actual rate cut. A month after the rate cut, the markets tend to go down. But generally here, 2 months, 3 months, 6 months, 12 months, we are generally positive. On a longer term chart, yes, we do tend to see a weakness coming into the rate cut, then a bounce followed by a bit of a consolidation and a rally towards the late cycle. Now, we could see this happening if the economy enters into a recession. In this case, we have 8 times this has happened and 3 times this has happened. So the current market correction, really nothing extraordinary happening in the markets. Now, what would be extraordinary though is a 50 basis point rate cut, 25 basis point rate cut, no problem, business as usual. Markets do tend to perform well after the first rate cut, but a 50 basis point rate cut would signal a much deeper problem that will force the Fed to accelerate this cut, and that would be terrible for the markets moving forward, right? A strong pivot really by the Fed will usually translate into a bear market with a drawdown of up to 58%. And again, a lot of things can happen between now and September. A 50 basis point rate cut is not something that we should be looking forward to, right? This week, inflation rate and BSP rate decision to cut or not to cut. Will we get higher inflation reads? The consensus is 2.9. Producers price index consensus is 0.1%. So many things to watch out for this week. Let's see what happens. In the meantime, let's chill. Watch patiently for opportunities. Do not overreact. Let them overreact and let us take advantage of that overreaction. That's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week.